We're back with Chairman's Briefing this week. I'm Rachel Lee, and this episode is brought to you by PTX Metals. The Federal Reserve delivered exactly what markets expected this week, holding their rates steady. But the real story is what Fed Chair Jerome Powell revealed about the road ahead. Powell made one thing crystal clear. The Fed sees no rush to cut rates. With unemployment still low and wages climbing, he called the central bank well-positioned despite the uncertainty ahead. But here's where it gets interesting for us. While their decision this week was unanimous, cracks are forming in their future plans. 9 of 19 policymakers now forecast fewer cuts than previously expected. 7 policymakers see no cuts at all this year. This is a dramatic shift from just 3 months ago. The most concerning development is that Powell painted a picture that looks dangerously close to stagflation without actually saying the word. That's rising inflation, climbing unemployment, and sluggish growth that could force the Fed into an impossible choice between fighting inflation and protecting jobs. For investors who are in precious metals, this scenario historically spells opportunity. Gold tested $3,400 this week as Middle East tensions flared with fresh regional escalation. But Bank of America analysts say that the real driver to $4,000 has nothing to do with geopolitical headlines. The investment giant maintains its 12-month target, pointing to a fiscal crisis that's brewing in Washington. Congress debates another spending bill that's expected to balloon deficits by trillions of dollars. Meanwhile, central banks are continuously ditching U.S. debt for gold bullion. The numbers are that central bank gold holdings now equal 18% of outstanding U.S. public debt, up from 13% just a decade ago. Bank of America calls this a warning to U.S. policymakers. Of course, there are a few naysayers who don't view the metal's current price levels as sustainable. Citi Bank threw cold water on the gold rally, slashing price targets and predicting a drop below $3,000 per ounce by early 2026. Citi Bank also cut its near-term target to $3,300 from $3,500 an ounce, citing declining investment demand ahead. Here's their reasoning. President Donald Trump's policies will boost U.S. growth and reduce safe haven demand for gold. As the 2026 midterms come up, political stability could send gold back to $2,500 to $2,700 per ounce. But Citibank says that they see a stark contrast in silver. They maintain a $40 target over the next 12 months with potential for $46 in a bullish scenario. Tightening supply and robust industrial demand separate silver from gold's investment-driven rally. Silver continues its march higher, testing levels that's not been seen in over 13 years as momentum builds towards what some bulls believe is inevitable, a run at $50 per ounce. Bank of America analysts are sticking with their $40 target despite the rally arriving months ahead of schedule. The fundamentals remain rock solid. Silver markets stay in deficit due to constrained mine supply, while the gold to silver ratio has finally normalized after years of silver underperformance. Technical analysts see clear sailing with strong support levels holding firm. The path to $40 looks increasingly likely as resistance levels continue falling. Here's what smart money may know. Physically backed silver ETFs are seeing massive inflows as investors recognize silver as the new safe haven. Industrial demand remains relentless while mine supply stays tight. PTX Metals just announced a discovery that could change everything at their Ring of Fire project. PTX found significant platinum group elements throughout their drilling zones. These are precious metals that were completely underestimated in previous exploration work. So this isn't just about their 49-meter intersection. It's about a resource estimate potentially reaching 135 million tons with platinum, palladium, and gold credits that were barely accounted for before. So the market hasn't priced this in yet. PTX sits on a critical minerals deposit in mining-friendly Ontario with holes that are spaced 100 meters apart, confirming mineralization remains open in all directions. Korea Zinc is placing a big bet on the future of deep sea mining. The Korean refining giant bought a 5% stake in the metals company at $4.34 per share, with warrants to grab more at $7. Korea Zinc brings world-class refining tech to process the metals company's seabed nodules into battery materials and copper foil. The partnership comes as President Trump fast-tracks seabed mining permits through an executive order. Here's what else matters for investors. The metals company submitted the first ever commercial recovery permit application under U.S. law. They expect a pre-feasibility study next quarter with nearly $127 million in cash to fund their operations. Sprott plans to buy about $200 million worth of physical uranium after raising twice as much money as planned via a bought deal. Canaccord Genuity acquired 11.5 million units at $17.25 each, which is double what had been announced hours earlier. So strong investor demand here led to the size increase. Here's why this matters. So when Sprott buys $200 million of physical uranium, they're removing that supply from an already tight market. Demand already outstrips production by 50 to 60 million pounds on an annual basis. Spot uranium prices rose 5.5% in May on renewed investor confidence. Global demand is projected to triple by 2040 as tech companies build nuclear-powered data centers. And President Trump's nuclear framework provides the strongest government support in decades through executive orders that target uranium mining and reactor deployment. And that's your briefing for this week. If you're not subscribed yet to the CEO.CA channel, do so before you go. I'm Rachel Lee. Thanks for watching.